Welcome all to this course, Accounting Frauds. This is session 3, where we'll be discussing Unit 3, which talks about financial statement frauds, which will be explained by myself, Ms. Havila Johnson, and Ms. Sheetal R.
So we both will be presenting about financial statement frauds. Havila will be taking up the meaning, causes, impact of financial statements on business, and also an example. I'll be covering the role of an internal auditor, fraud prevention techniques, and role of present internal audit. Let's begin.
Okay, to start off with, we'll be discussing what is financial statement fraud. So, financial statement fraud is basically the deliberate misrepresentation of the company's financial statements. So, this can either be through omission or maybe you're exaggerating the list of items that are presented in the financial statements in order to show a more positive impression of the company's financial position or their performance or cash flow. So the motives behind that is maybe some could do it for their personal gain, or maybe to keep the business afloat, or to retain their status as a leader in the organizations. So what the fraudsters attempt to do is they either try to inflate the perceived worth of the company and make the stock appear more attractive to the investors. They might do that to obtain bank approvals for loans, or maybe to justify large salaries and bonuses where their compensation is tied to the company's performance. Now, looking at what are the causes of financial statement fraud. So, there are many factors, but if we look at two broad reasons or causes, one could be the pressure to meet the financial targets, and the second one is lack of ethical standards. So, when we talk about that pressure to meet financial targets, what happens is this pressure can be from a variety of sources, maybe through your investors, your creditors, your analysts, or your senior management. So, when the company's financial performance falls short of these targets, what individuals do is they are compelled to, or they feel the need to resort to such fraudulent practices to make the numbers look better. So, for example, what one can do is they might inflate the revenue, or they can understate the expenses, they can manipulate the accounting reserves to meet the earning targets. Talking about lack of ethical standards, what happens here is if the company or the organization is not having a proper culture, not having a proper ethical standards in place, then it can be like the employees may find they may be more willing to engage in fraudulent practices to benefit themselves or the company. So this can be especially true if the employees see fraudulent behavior done by their senior management only, or it is tolerated by them itself, and it might be difficult for them to speak up when they see such fraudulent behavior because of no proper ethical standards. Next, talking about how what is the cost and the impact of such financial statement frauds on the businesses. There are 5 points that I've listed out. There are many, but we're restraining to 5 at the moment. So one is the financial losses. Obviously, all of you know that financial losses in the sense that if suppose if revenue is inflated or expenses are understated, then the company will appear to be more profitable than it actually is, which is a wrong, it's a misrepresentation, right? It leads to overvalued stock prices and inflated bonuses that is paid to executives. But when the fraud is identified, then the stock prices will plummet and it will lead to significant financial losses for the investors and or the company. Talking about legal liability, it just means that they'll have to pay huge fines, penalties, or they'll have to face lawsuits from shareholders, investors, or regulatory authorities. So in some cases, they'll also be fined with criminal charges. Talking about reputational damage, here it means that here when the fraud is discovered, it can erode the investor's trust, it can damage your relationship with your customers, and once that's lost, it's very difficult to regain it back, right? So this it can make it more difficult for the company to gain or to attract new investors, to raise capital, or to conduct business in the future. Next point is the regulatory scrutiny. Talking about regulatory scrutiny, it means that we'll be under constant investigation here, and it is very time consuming and costly for the companies also. It is in addition to the fines and the penalties that they'll have to face. And the last one is the employee morale. So here it will cause a very negative impact on the employees. They may not be, they'll feel demoralized, or they'll feel delusioned with whatever company's values are and the culture is. Next, to give you one example of a financial statement fraud, there is one is Enron scandal, which is one of the famous scandal. So Enron is actually largest energy trading company in the United States in the early 2000s. So what had happened was they engaged in a range of accounting fraudulent accounting practices, which made its financial performance look better than it actually was. So one of their primary tactic, what they used was they created an off-balance sheet entity with like partnerships, so which allowed the company to keep their debt and other liabilities off its financial statements. And they also engage in manipulation of reserves, which involved inflating reserves to smooth out earnings, and they create appearance of financial stability. So this is a classic example of a financial statement fraud, which has significant consequences and cause a lot of reputational damage. So further topic will be taken up by Sheetal.
Now I'll be explaining about the role of an internal auditor. The role of an internal auditor is crucial in detecting and preventing financial statement fraud within an organization. So the first point, evaluate the company's internal controls. Internal auditors must review and evaluate the company's internal controls in preventing the financial statement frauds. And the second one, conduct regular audits. Internal auditors should conduct regular audit of the financial statements and accounting records to ensure they are accurate and complete. And the next one, investigate suspicious activity. If an internal auditor notices any unusual or suspicious activity, they must investigate it immediately and stay up to date on regulations. Internal auditors should stay informed about changes in accounting standards and regulations to ensure that the company is complying with all the legal requirements. And finally, it's report findings. Internal auditors must report their findings to management and the audit committee as well. Next slide. These are some of the fraud prevention techniques. The first one is employee training. Providing employee with regular training on fraud prevention can help to create awareness and reduce the risk of assessment or statement fraud, financial statement fraud, sorry. And next one is whistleblower programs. Having a whistleblower program in place can encourage employees to report suspicious activity without fear of getting caught, or this can help to detect and prevent financial statement fraud before it becomes a major problem. And the next one is monitoring systems. Implementing monitoring systems such as automated fraud detection software can help to identify the potential fraud in a financial statement. Code of conduct, and developing a code of conduct that outlines ethical behavior and expectations for employee can help prevent financial statement fraud. And finally, it's independent review. Organizations can hire an independent third party to review their financial statements and provide recommendations for improving the internal controls and reducing the risk in the financial statement fraud. Next slide. So finally, this is a role of press in financial fraud. The first one is publicity. The press can bring attention to the financial statement fraud by publishing articles and reports that highlight the fraudulent behavior. And the second one is investigative reporting. Investigative journalists can conduct in-depth investigation into companies suspected of financial statement fraud. And the third one is whistleblower protection. The press can provide protection for whistleblower who come forward with information about the financial statement fraud. Advocacy. The next one is advocacy. The press can advocate for strong regulations and oversight to prevent financial statement fraud, which usually occurs. And finally, it is public education. The press can educate the public about financial statement frauds and the importance of the ethical behavior in the business. By informing the public about the consequences of fraud, the press can help to promote a culture of transparency and accountability.
Thank you.
Thank you.